Welcome to the Life Self-Mastery Podcast, where we bring in entrepreneurs who have created online businesses and improved their lifestyles. Here's your host, Rohit Malhotra.
Hi everyone, this is Rohit from Life Self-Mastery, and today I'm thrilled to have Sajid Rahman, who's an international leader with a director-level exposure in key emerging markets. He's currently building a global digital health company, and he also works closely as advisory board members and investors to technology and energy companies in US, Asia, and UK. He's built the first technology accelerator program in Bangladesh, as well as the first accelerator program for the rural areas. He's a prolific angel investor in more than 500 companies from Silicon Valley, Southeast Asia, and Africa. His portfolio includes, among many, like Xendit, Snyk, FabFitFun, WeFox, Rappi, Clutter, etc. Thank you so much for coming onto the show, Sajid.
Thanks, Rohit. It's a pleasure.
Awesome. So, you have a very interesting background. You were a banker earlier, then you built you're part of Telenor company. How did you get into the world of investing into startups?
So when I was in the banking, a couple of young entrepreneurs approached me. They were into fintech space,
right,
and they wanted someone who understands the banking regulations and can help them in navigating the regulatory landscape in banking world. So they wanted an advisor, and I started advising them. They were into a comparison sites, but after a few months, they wanted to raise some funds, and given that I already knew them, I wrote a small check, a personal check. But then there were other angel investors on that round, so I get to know them, and they sort of introduced me to the whole world of investments.
Right.
I got really hooked into this whole process and the excitement around it, and then of course I started writing now almost in 500 companies.
Got it. And Sajid, you've invested across the world. What do you think about portfolio construction when you have such a large portfolio with you?
I think one of the basic things for angel investment is, of course, the earlier you go into an investment cycle, the wider the portfolio should be,
Right.
because you're taking high risk. It is not a spray and pray method, but the portfolio should be large enough to absorb geographical risk or stage risk or vertical risk and stuff like that. So when I started investment, I was not very consciously doing it in the sense that it's not like I was writing a same amount of checks per year and things like that, which I got to know later as I went through all these investment books and podcasts and all those things.
Right.
But I mean, I at a very early stage, I did have an idea that if I don't spread my investment bet big and large enough, it might be quite risky. So anyone thinking of going into angel or seed stage or early investments, portfolio construction is very critical.
Got it. And you interestingly has spent a lot of time on emerging markets, especially India, China, Indonesia. How much of your capital allocation does go into emerging markets, and is it still attractive, going forward to be into emerging markets, or is your advice is to invest more into US companies?
I think emerging markets is still early, so
right.
there is a big delta to have in these markets. In terms of my total capital allocation, of course, I'm not using the book value because that would distort the whole outcome. But in general, in terms of the amount of checks I wrote so far, I think roughly 70% would be in developed markets like US and Europe, right. And the rest 30% would be in emerging markets. But of course, I mean, if I take the book value, it will be 60-40. The reason actually is that when I started my investment, I was mostly focused on US, given that all the platforms available to access deals. But as I went deeper into investments, I of course have developed a network to have a good deal for access for emerging markets, and started skewing towards that. So while I started writing checks a bit late on the emerging markets, I am actually now writing more checks in the at least past year or so in emerging markets.
Right. And do you think, China, India, and Indonesia with the young populations and more consumption are going to upstage, the developed countries in another 10 or 10, 15 years?
Oh yeah, I mean, I think in terms of course, I mean, it's a risk versus return. So emerging markets businesses clearly high risk. So because for the simple reason that the ecosystem is not developed enough.
Right.
So getting later rounds is difficult for startups in this market. So sometimes the startups are not, in many cases, startup founders are first time, so they don't have enough experience like you usually get in some US cases. The team building a good team is also difficult. So there are all these challenges in emerging markets, but at the same time, if one can get into a startup at the right price, I think the delta is much higher. Because I firmly believe, whether it's India or Indonesia or markets in Africa like Nigeria,
Right.
I firmly believe these are very early stages of digitization. I mean, we have seen what, the recent bet by Facebook in Geo. And this clearly shows that, the global companies believe that there is a long runway in many of these markets. And I mean, if you look at some of the data in terms of mobile penetration, that's very high. But if you look at the data usage, that's still not there or where it can be. So clearly there is a play to be made here.
Right. I have much younger, listeners who listen to our podcast, and they would want to start writing checks. What is your advice to them on how to, look at angel investing? I know you've invested into 500 companies, but any advice for younger, founders or entrepreneurs or people who want to get writing, smaller checks into companies? Or what should they still focus on developed markets, or should they look at the local economies and start helping out and advising and investing there?
So I think there are a couple of things anyone going to investments should keep in mind. First of all, that person needs to build a portfolio. It's not about writing one or two checks. A person at least should have invest in 10, 15, 20 companies, if not more.
Right.
So that's one. Second is if a person is starting to write his checks. I mean, one of the mistakes I made is this whole FOMO thing, right? The fear of missing out.
Right.
And
right.
that sometimes makes one rush to write checks into companies, which the person may regret later. I think one thing to remember is that even if you miss a good company, there will be another company in the horizon. So don't get into this FOMO. Take your time, do the due diligence, and then write a check. So that's the second one. In terms of the, one of the things, given the way these platforms have developed over time, this whole syndicate concept really helps, because that essentially means that you are writing checks along with people who have already done that and learned from their mistakes. So that way, as an early investor or as a first-time investor, you are making you're getting advantage of the experiences of others. So if possible, get into the syndicates and try to co-invest with others who have already done it. So that way you can avoid a lot of mistakes. So that's the third. And on the question of local versus international, I think, I mean, depends on what sort of investor you want to be. If you want to invest in startups just as part of a portfolio construction, i.e., let's say you have hypothetically, let's say $10,000 of that you want to spend, invest 5,000 in public market and 5,000 in startups, and then forget about it. Then I suggest you get into syndicate, and if the syndicate brings a deal in, let's say in India or Indonesia or in US, you go along with it. Yeah. But if you want to be an investor who actually want to also get involved with startups in terms of helping them, giving advices, then clearly, I mean, if you're into the locality, that helps in terms of access.
Makes sense. Sajid, you also been a founder in companies, and you also invest on the side. How do you split your time, and what does your day look like when you're actively investing and also running as an operator?
So my day job, of course, is building the health company, and given the whole COVID-19 thing, it's a very busy space now. So right. That really is keeping me busy. We are seeing huge traction on this whole health tech. So that really keeps me busy. But investment is sort of a passion for me, in the sense that it gives you a frontline seat to the best and the brightest of the world, right? So I have invested in companies, companies which are run by Nobel laureates, the the person who did the first sequencing of DNA. Very, very bright people, and when you invest in these companies and you get into a call with some of them, the exposure that one gets is really breathtaking. So I really like that exposure and get investment. What I usually do is, most of my investments are essentially I just invest and I don't get involved into companies unless the founder specifically asks for it. So most of the cases, my involvement is very minimal. I do a couple of cases where the founders actually ask me to help them as an advisor. There, of course, my investment or my involvement is more hands-on. But even as an advisor, we really don't get involved on a day-to-day. It's mostly like once a month, once in 2 months, whenever the founder needs help on any specific area, only then I get involved.
Got it. And are there any benefits of or any challenges of investing and operating simultaneously?
I actually think it's great. I mean, unless one wants to be a professional investor, right? So unless one wants to be an investor, like having a fund on his or her own and run it, then of course, it's very difficult to do both. I know people who do it, who has a fund, like I get other people money and managing it as well as operate. But, it's sometimes get difficult if the fund gets bigger. But in general, I think actually it complements very well. Given, the startup investment gives an investor so much exposures on a way of thinking, on the recent trend, the organizational challenges that are faced by the investee companies. There's actually a lot of learning. The learning is cross-border in the sense that whatever you are learning as an operator, you can bring that to the table when you're talking with the founders, and whatever you're learning from the founders, you can bring back to your operating role. So I think there's a very good cross-pollination that can happen.
Right, and you interestingly pointed about the COVID situation. So, what you've been working for a time where you've seen the 2008 subprime situation. What analogies of prior downturns and recessions can we look to learn from for younger founders who've not seen the recession before?
I think a couple of things. There is no harm being over conservative, right? So right. For the founders, if you think that, okay, I have a runway of 8 months, but because of this COVID thing, I want to extend my runway to 16 months or 18 months, please do it. There's no harm being conservative. The worst thing that can happen is that you are over conservative, so you probably didn't take advantage or grow as fast. But not being conservative can be very, very dangerous. I mean, nothing can be worse than actually shutting down the business. And, the jury is still out. What sort of recovery are you looking at? It is, I think, broadly agreed now that the V-shaped recovery is not happening. Well, that was the initial hypothesis. It's not happening. Right. So we are not going back to our previous way of life immediately. So the theory now is that either we go in U-shape or L-shape, depending on how long this shutdown continues, when we get the vaccine, whether there is a relapse of the virus spread and stuff like that. So we are looking at anywhere between 8 months, 12 months, 24 months. Some particular specific industries may actually take longer to come back. We're talking about airlines, travel, resorts, large games and stuff. So those may take longer to come back. So in this scenario, it's very difficult to compare with previous downturns because each downturn has its own. So one downturn was mostly driven by mortgage in banking sector, not driven by startups, but startups did get impacted because the cash flow got impacted. But then again, it came back within a few years. The other one, which was a dot-com bubble, I didn't see that, but the dot-com bubble obviously was driven by startups, and that obviously had a more of impact on startups, and it took longer to come back. This one is very unique in the sense that it is actually completely out of the realm of financial sector, right. Health sector, which is actually much more personal, much more closer to our everyone's. So the impact on financial sector is most likely second or third order. So it's a bit unique. But I personally think what we need to do for any sort of founder, reserve cash. If any way possible, reserve cash to extend the runway.
Got it. And So when you look at investing into startup, what gets you excited? Is it the team, the market, or the idea? Because you don't have too many numbers to run through. But how important is either of the three parameters?
So the way whenever I come across a startup, investment opportunity, of course, first I look at the market itself. I mean, the space they're working in.
Right.
So if that's something, I mean, because of course, as an investor, it's ideal to read a lot. And the more you read, the more idea you have of what's happening. So if it's something I find that, the trend looks very interesting and the space the startup is working in is quite interesting. So of course, that helps. The second thing is, so once it passes that initial, selection criteria, then I talk with the founder and find out whether I'm really excited about the founder's vision and the team. So for me, the space comes first. But I mean, before making a startup investment decision, I talk with the founder. Right. And if talking with the founder, it really excites me about the vision, then I invest. So you can say that the team actually is the decision criteria finally.
Got it. And since you invest, all across the world, how do you get the deal flow? Is it through angel list syndicates, or is it through accelerators? How does a somebody who wants to build his portfolio construction across geographies look at deal flow?
So I get quite a bit of deal flows from my personal connections because I work in Africa. I know quite a few guys who are quite active in the ecosystem. I of course know quite a few guys in Southeast Asia who are quite involved in ecosystem. Know many in India and of course quite a few in US. So those network really helps. I mean, and all this started none of this happened overnight, right? So all this happened over time when I invest in one company. For example, I have seen many cases where one founder, referred another founder to me. So a lot of my deal flow came from those referrals where a founder, where I invested, referred the other founder to me. So that's one. Of course, the syndicates like Angel List, Funders Club, those really help because, again, I mean, the people who are running many of these syndicates are also personally known to me. So, so we develop a relationship over time. So that also helps. But I think the good thing about this Angel List Syndicate and others, because they have automated a lot of things, a lot of these networking, connection, deal flow, that for any new investor, that's a very good way to start.
Right. And do you think, the angel list syndicates will disrupt venture capital one day? Or is it going to be, a part of, seed stage capital?
So what's happening in angel list, actually, there are many late stage deals. I mean, I have seen deals in angel list which are valued at billions of dollars, right? Oh, and those are like, and we all know those companies by name. So angel list actually is no longer, confined to seed or early stage. I mean, they have pre-IPO deals, late stage deals, unicorns coming there to raise. But of course, I mean, in angel list, you are not going to raise 10 or 15 or 20 or $50 million, right? So when you're a late stage company, you're mostly raising somewhere with the VCs, and then angel list is probably coming out with checks of a few million. So I don't think platforms like angel list can replace or will replace late stage VCs. Right. Because that requires the investors to take a board seat, get really involved with the founders and stuff like that, which angel list syndicate or the syndicate leads may do at early stage, but not at late stage because they still can't write that level of checks. So these two will coexist. Where angel list probably has disrupted already is early stage funding, especially pre-seed or seed stage, where it has it has not completely eliminated our seed fund, as we can see there are many seed funds now, but it has become quite a good source of funding for many startups.
Right. And, before the call, we were talking about Sequoia and other funds, especially, SoftBank and, other large funds who are playing at seed stage. So what are your thoughts on that? Do you think, it's a good idea for Sequoia to come out with Sequoia Search and SoftBank also looking at seed funding?
Well, these are just, where to get a deal flow, right? So what's happening is, you see all these late stage funds, which has raised billions of dollars.
Right.
And they first, I mean, obviously things will change after this COVID thing. But before
Right.
COVID thing, it was the founders war, right? So founders were negotiating a hard deal. Investors are fighting with each other to get into these deals. The price where valuation was sky high. So all those things created a FOMO, and then all these large funds, they have raised billions, and they thought that can we get a dip in the company earlier, so that they can later lead the later rounds. So that's where a lot of these companies came in a bit early. And you see SoftBank launching their own, early stage funds. Sequoia started all these programs for Surge and everything. So these are all in an effort to get deep into a company early in their cycle, so that they can later, lead the later rounds and stuff like that. Yeah, so those are there. Of course, things will change after this COVID-19 thing. I think many funds will go away. Many
Right.
small seed stage funds will go away. Many funds will struggle to raise their new funds on their own from LPs, because LPs will start reallocating, especially institutional LPs, because their public market exposure will get is already impacted. So they'll start reallocating funds between different portfolios. So there'll be a challenge. There'll be a fund crunch, and then of course, that means that startups raising funds will be very difficult. But those who will raise funds will have an easier way to build, because the cost will go down.
Right. And you've talked about the COVID scenario. How much do you think the valuations are going to change? Or do you think they're going to be more flat and down rounds going ahead?
Yeah, it's already happening. So what I'm saying now is, so three things are happening, right? So there are a group of companies who were basically didn't make it, in the sense that didn't achieve the unit economics, didn't achieve the product market fit. We're already struggling. So those companies are dying away in any case. It's just accelerated now. Then there are a couple of companies which were doing well. Airbnbs and other companies which were, really star, but it's just because of this event, their revenue has fallen by 70, 80, 90%, in some cases,
Right.
100%. So
Yes.
for them, raising a fund means taking a flat as a best case, or in many cases, taking a down round. And a cut maybe anywhere between 20% to 40%. And I'm already seeing that happening. And then, of course, there are very few companies which are actually having, this event as a tailwind. They're having better engagements, lower cost of acquisition of customers. So they're raising an up round in these cases, but they are very limited. In most of the cases, it is either flat or a down round of 30, 40%.
No, interesting. You pointed out about certain sectors which are going to do well. We understand that the real estate market or the travel industry might not do so well. But are there any sector areas where you think like the customer acquisition costs are going to go? And let's take the example of Zoom. The MAUs have gone 10, 20 times over the last 3 months. But are there any areas where you find that, after the COVID area, this is where the founders can start looking at building products?
Oh yeah, I think so. Two things I think in general is going to happen with COVID is this whole digitization of services, so offline to online. I think that will really ramp up, because a lot of people through this COVID experience are now consuming services digitally. So that is driving a behavior which probably would have taken longer. Now it has significantly accelerated. So I think in general, it's good time for tech companies, because where they were struggling a lot on consumer adoption has happened. COVID has pushed it. So it's good as an overall umbrella for tech companies. Now within tech companies, of course, there are areas which are clearly getting advantage. So of course, health tech is a big thing. The whole consulting doctor over phone video was difficult as a behavior, but now it has really pushed it. Ed tech, we are seeing, has benefited from that. Any products working with collaboration tools, remote working, they're having a good time, and they will continue to see the upside. Video streamings and others obviously has benefited. Gamings have benefited. I will say indoor farming that will benefit. You'll see, delivery, grocery deliveries and others that obviously has benefited and will continue to benefit. So e-commerce in general will probably come out as a winner out of this whole space. So even, not ride sharing aside, but, the scooters and the bike, they may come up as a winner out of this whole episode. Yeah. So there are many spaces where after COVID-19, I think there are huge scopes to build businesses.
Right. Interesting. You pointed about offline retail moving to online, and we've got to talk about the Facebook investment into Reliance Industries in India, where they made an investment of $5 billion for a 10% stake, valuing Reliance Jio at a $55 billion company. So do you think it's very interesting how the Indian ecosystem has allowed Amazon and the Walmart to enter into Indian ecosystem? But do you think it's a good idea for Facebook to invest into India? And do you think are there going to be any challenges about data sharing and all?
There would be, but I think so the reason Facebook invested in the Jio is quite clear, right? So Facebook started this whole the free Facebook app at one time, but then
Right.
of course they couldn't do it because of the whole net neutrality thing and stuff like that. So for them, this is a very clear way to get into the India market. The other thing is the WhatsApp. So I invested in a company called Vahan, which is based out of WhatsApp. And the usage of WhatsApp in India is so high that you are seeing people building businesses. And I think you probably have noticed that JioMart launched on WhatsApp and stuff like that. So clearly there's a lot of synergy to be built here. And given the whole infrastructure that Jio has built, by giving people access to data at a very almost nil cost, that opens a huge opportunity for companies like Facebook and WhatsApp to really build their businesses. So that would be good. In the end, I think consumers will come out as a winner because there'll be more competition and they will get products and services at a cheaper cost. So I think overall it's a net positive for Indian ecosystem.
Got it. And before the call, we were talking about Y Combinator as where as a founder, Y Combinator has had done great benefits to the founders. We got Harshal Mathur, who's the founder of Razorpay, who's come onto a podcast, and there's some great benefits. But for a founder, somebody into their 20s who looking at getting into the startup game, do you think Y Combinator has a better signaling, or they should do an Ivy League MBA, or do you think a Thiel fellowship brings a lot of utility in credentials if they want to build a unicorn sort of business?
So I think you are to the system, your grading, your class attendance, everything. So the more you're conforming, the better your grades are, and the better your schools, universities you end up with. So that's what the Ivy League, and others make one person do and reward them. Building a startup, of course, is very different in the sense that you are going against the society. In many cases, you are trying to build things which society didn't think it will need, or people, in many cases, against the grain, taking a huge risk. And of course, this huge risk is rewarded by society if you become a successful. If you don't, then of course it's a very different issue. Thiel fellowship is a bit different. I think, my personal view has always been is that for young listeners to this podcast is that do a degree, a good degree from Ivy League or wherever, so that you have a fallback options and stuff. And then go on, build your business, whether it's, or if you want to do a job. There's nothing wrong doing a job if you want to do, if you're, it's all good. But if you want to build a business, get an MBA and then go and build a business. This whole myth that, dropout founders, that really doesn't work. I tell you, of my 500 or so companies that I've invested, I don't think there's more than 4 or 5 who are dropouts. And in almost all cases, these guys are from all Ivy League school, from Harvard, Stanford, MIT. You name it. These are the people who went on and built all these businesses. So yeah, so I would say follow that route.
Yeah, no, I think the media loves to play that story that you don't need to do an education, but
yeah.
But as you rightly pointed out, just 4 out of 500 startups.
Yeah.
So that's quite a signal. And you have invested into a lot of fintech companies, and your recent investment has been a Nearpay. What made you invest into them, which is a part of your syndicate?
Nearpay is a very interesting company. Of course, when I talked with the founder Abhishek, I was really impressed by his vision and what he's trying to build. The thing that really it really clicked to me because I know the pain point very well. Being someone from Indonesia, from Bangladesh, from all these emerging markets, is a huge cash on delivery business. We know e-commerce is going to be big. It has shown all the signals, and it's only going to be bigger from where it is now. We know that all these markets still a bit of way to go on getting credit cards in everyone's pocket and digital wallets and all these things. So Nearpay solves this problem. And interestingly, there are similar companies in other markets, especially in Indonesia, which has done very well. So, we knew that there's a very little business model risk because this is proven. The team is very solid. So there is little execution risk, and they will get the tailwind from all the things that are happening with COVID-19. So all these things coming together, it was an easy decision.
Right, and you also run your own syndicate. You've been doing for a while. What is we'll share the syndicate link for the listeners. But what is your thesis when you're looking at leading that syndicate, so that other backers can join you? And since you've done angel investing for such a long time, what excites you, and what is your final aim? Do you want to be a syndicate lead, or do you want to create your own fund?
Yeah, so I think the reason I have started syndicating this is because after writing checks on 500 companies and stuff, I have seen the performance of quite a few of these companies, and I get a feeling that I have a good way to judge founders and the companies, given the track record. Because I have almost around 12 unicorns in my portfolio, and these are all from seed stage. So, I could see that, I have the decisions are not always that bad. So, what used to happen is, I used to get requests for running a syndicate, but I thought I was so busy. So let someone else. So I used to pass on those to others to run the syndicates as a referral. But nowadays, I thought, okay, let me do it on my own. So I started running it. My thesis has been to, of course, I don't have any sector-specific focus, but there will be a bias towards fintech where I understand the space very well. But given my exposure across health, education, e-commerce, and mobility, I invested in Yulu Bike in India, and so I've seen quite a few in many spaces, and then that would help me to judge those companies. So I'll probably bring in if I find any company that's exciting. So it's not it's broadly sector agnostic, but it will mostly be at seed or a bit of late seed, maybe seed plus, so that there has been some traction. There is a clear monetization, and the team is quite strong. And there is a bit of a social, recognition in the sense that there are 1-2 good investors already on the cap table. So it reduces quite a bit of risk in the investment that way. But also the valuation is not that high that the return multiple gets compromised. So that would be a summary of the thesis. In terms of geography, it will mostly be emerging markets, and will be very few from US and other markets, but would mostly be from emerging markets of Asia, Latin America, or Africa.
Correct. And, I wanted to touch base about valuations. When you're looking at seed and seed plus, do you have any metrics or any valuation numbers which signals that, you would not want to invest, like, somebody is trying to raise a seed round at a 10 million pre-valuation or anything like that?
Not exactly. See, the challenge with with this term of seed plus series, it has lost much meaning because the border has been removed. Right? So
right.
So some people call one company which is still probably that's the third round. They're probably already valued at 30 million, but they're still calling it seed, right? Just seed plus, seed extension, different names, but they are too reluctant to call it Series A. So it's difficult, but I think, irrespective of the name, it is the valuation, which is a multiple of the revenue or the GMV, depending on which business they're in, there are different criteria of valuation. So as long as those matches with the valuation, I'm okay. Whether they call it seed, pre-seed, seed plus, pre-Series A. So, right. Whatever they call it, as long as, that valuation makes sense, I'm okay.
Correct. And, I quickly want to do the top 3. What's your favorite business book?
So actually, interestingly, though while I didn't support much on Thiel Fellow, it's 0 to 1 by Peter Thiel.
Right.
So I really like that book. Yeah.
Got it. And if you could go back in time when you started, angel investing, what is the one thing you would have focused on or done anything differently?
I think I would have waited it out a bit more. So when I started this investments, I got a bit of, I got so excited I started writing checks quite frequently, irrespective of, so I probably would have waited out a bit and do a much more phased investments.
Right. And do you have any favorite online tools, for example, Gmail, Slack, Zoom?
Slack. So I use Slack quite often for different purposes. So Slack would be one of the most used online tools by me, and then Microsoft Teams. Yeah, that's for my office purposes.
Got it. And what is the best way people can reach out to you and get to know more about your syndicate?
So obviously for syndicate, I know you'll put in the link. So one can go to AngelList, follow your link, and just support it. If there's no commitment, you just support, and then of course, if you like a deal, you invest. In terms of reaching out to me, I'm very available almost in all social media. So in LinkedIn, someone can connect with me and send a message. I'll get it. If someone, I have my own personal website, www.sajidrahman.com. Someone can go there and drop me a message. Of course, AngelList, if someone was following me or supporting my syndicate, this can send a message there. And also in Twitter, I'm at Sajid Republic. So if someone wants to connect me there, they can.
So we'll put that in the show notes. Thank you, Sajid, for coming over and speaking to us. I really enjoyed speaking to you.
Great, Rohit. Thanks for the talk. Really enjoyed it.
Thanks for listening to the Life Self-Mastery podcast, where we teach you how to start and grow your online business. For more information, visit Rohit's blog at www.lifeselfmastery.com.